Welcome to BizTech's Property Show, the show where we look at property markets globally and give you insights to help you manage your existing properties, get better returns, and also help you make better decisions about your future purchases. Today, we zoom in on the importance of REITs and how the sector is performing during this turbulent period in world history. Now, our guest today is Dato' Stuart Labroy, Honorary Secretary of the Malaysian REIT Managers Association, as well as the chairman of Alpha REIT Managers, Adrian Berhad. Dato' Stuart, welcome to the show.
Thank you for inviting me, Brian. I'm looking forward to the conversation today.
Now, Stuart, could you start by giving us an overview of the Malaysian REIT Managers Association and your history?
Okay, the Malaysian REIT Managers Association, the MRMA, or as we call it, Mr. Ma. I hate acronyms. We find ways of dealing with them. But when we started let me go back a bit in history here. When we started the journey of REITs, REITs actually were in Malaysia in the 90s. They were listed property trusts, but the regulation environment was very anti-business. They could only be run by banks, and banks aren't property people, as you well know. Mm-hmm. So that failed miserably. They're all trading 50 cents on the dollar. And eventually, when Singapore started their REIT regime, the Securities Commission here saw it as an opportunity to revamp the LPTs, or listed property trusts. So they changed the regulations and set up their REIT regulations in 2004. 3 and 4, they were drafting them out. We were coming out of the horrible Asian financial crisis. I was at the Axis Group. We had about 5 investment properties that were primed for injection into a so-called REIT. So we studied the market, and I was given the job of taking it to listing. It was very small. It was only $300 million listing. Tiny by today's comparison, but it was the first one in Malaysia. It was basically the third after Singapore. So right on the heels of Singapore. So when we listed it, I was astounded. We were nearly 20 times book. And everyone was clamoring for stuff. And the day it opened, we were up like about 35%. And it never went down after that. And since then, because we came out of a recession, we were able to buy very well some brilliant properties and add them to the portfolio. So moving forward, around 2010, we had other REITs join the fray. Sunway started their REIT. We had the Pavilion REIT. We had YTL coming on board. So we had about 10 of us actually were listed at the time. And we had a real problem trying to get the regulations tweaked to suit our businesses. So we all said, rather than individually going to the Securities Commission and asking for this or that, we formed an association. So I spearheaded the formation of the Malaysian REIT Managers Association. That was in 2010. After 5 years, I stepped down as chairman because at the time I left Axis REIT, so I didn't have a home to call myself part of the association.
Okay.
And then I soon started my own REIT. There was Alpha REIT. And so I was readmitted into the association again. So I'm now secretary of the association.
And tell us a little bit about Alpha REIT and what you're doing right now.
Well, Alpha REIT is a very unique, when you do something, you never do the same thing again. Someone said, why don't you go start another industrial REIT? I said, I don't want to. I don't want to do what I call a rewind job. I really want to look at new markets. And we looked at the market and said, education looks very attractive. Why? Okay. Everyone knows schools. Don't forget, schools are part of your life from the time you're maybe 7 years old till the time you die. Do you realize?
Yes.
You start off going to school, then you get married, then your kids go to school, they get married, and their grandkids go to school. And guess who gets to take them to school? Grandpa. Okay, so you've got this lock-in with the education system. And people are very emotionally attached to schools. Your alma maters are like, today, you're so proud of which school you went to. Irrespective of if they're good or not back then, they were all okay, I guess. But the loyalties you develop, now I'm a LaSallian, I come from Victoria Institution, or, I'm a Bukit Bintang Girls' School, I'm convent, St. John's, they're all very proud of the alma maters. So it does create a lot of emotive attachments. So we thought the real estate would be a wonderful idea if we get the schools to distance themselves from ownership as opposed to operations. Because the schools, all they're interested in is operating. The real estate's really drag on their balance sheets. So we started the journey. We've got 3 very good schools on our portfolio. We're looking at a few more. The owners were delighted. They were able to, unload the assets, reinvest them in new schools. And later on, they'll sell it back to us, and then we'll go again and do another round of capital recycling. So it just builds out a portfolio. But the wonderful thing about it, that the leases we have with schools are immensely long. They sign deals up to 30 years. You don't get that in any other real estate investment trust because they know they're there for the long term. They're not going to run away. They have such commitments to their students because they're there for 12 years. It's pretty fail-safe. So we found it very attractive.
Now, how is that influencing the returns? Because obviously you're able to lock them in for a long term, but does that impact your ability to enhance returns for unit holders over a longer term?
Well, a lot of the assets we buy have additional land that they bought, they wish to redevelop, so we do that for them. We add more area to the schools, which they lease back, gives organic growth. You grow through two ways, organic or through acquisitions, okay? And you do very careful capital management to maximize your yields. So long as the schools are giving organic growth, you're assured of an uptick in your returns every year. And that builds out your worth, your portfolio. When that happens, Brian, your share price goes up.
Yes, of course.
If so you do share price growth together with, don't forget, REITs are wonderful because the big chunk of your returns are cash. Mm-hmm. And you have a capital gain at the end of it. So if you add the two together, for a long time, Axis was giving people like 15 to 20% returns because the values of the assets were rising all the time. And the fact that we bought very fast and very quickly, be able to grow our distributions very quickly as well. So that gave shareholders a wonderful opportunity. On top of that, we used to trade assets as well.
Okay. So that enhances your asset, we
always say, you've got to cull the herd. The big mistake some REIT managers make is that they don't want to sell any assets. But you'll always get some laggards in your portfolio. And what we did was when they felt they matured and we couldn't get anything more out of them, we sold them. And what we did was very interesting. We didn't take all the money back into the balance sheet. We took back the investment and all the profits were shared amongst all the unit holders. They loved it. It gave them a turbocharged return for that year. And when we sell a property, they're all very excited because they know they're going to get extra returns because the profits go back to them in dividends.
Oh, you retain some of the earnings to reinvest?
No, most of the earnings, the capital investment.
The capital investment, yeah. Sorry.
Yeah. So we reinvested that in new properties. Okay. But we felt that the unit holders need to be rewarded by giving them back the capital gain back to them. Because if you're an owner of a property, when you sell it, the capital gain is yours. We treated the unit holders like real owners of the asset, not third parties or just shareholders. They were part and parcel of the whole experience. And that was a different dynamic I think we did in the markets. No one else does that. I think we're the only ones that actually do that.
Stuart, you mentioned that Axis REIT was the third REIT to list way back when you did, I think in mid-2000s, I think after REITs in Singapore. But yeah. Singapore has moved ahead as REIT Central. Could you tell us why that's probably happened and how will Malaysian REITs compare to Singaporean REITs in general?
Well, we went from a $300 million business to a 40 billion ringgit business. Our problem is that for everything we buy here, if Singapore buys the same thing, they get 3 times the value. Our money is just not worth that much. So our portfolios are 40 billion. If it's Sing dollars, it'd be worth a lot more. So it's a different animal altogether. No, Singapore succeeds largely because of its capital controls, the fact it's a financial center. A lot of REITs in Singapore actually are foreign assets listing there to monetize. And they're basically other REITs actually listing in Singapore. So the Singapore REITs are quite contained. There's limited stock in Singapore. But Malaysia has a much larger ability to generate stock and put into portfolios. But the value of our assets, as you well know, are very, very low compared to our neighbors, especially Singapore or even Australia.
And so therefore, again, as an investor, you go in where there's a bigger upside, and Malaysia, in your opinion, would probably represent a bigger upside.
Of course it is. Because at the end of the day, the whole world's going to realize that, hey, we're across the pond from Singapore, and technically speaking, there should be some kind of comparables between the real estate between both nations. And the fact that we have abundant land, we have amazing infrastructure. We're the best infrastructure outside of Singapore, bar Hong Kong and Japan. We have everything there, for investors to come to. It is really a wonderful opportunity, but we've never been able to sell ourselves well. That's a big problem.
I think Malaysia has an image problem, whether it's real estate, whether it's technology, we've not been able to sell ourselves well.
No, we were actually, I always say, once we were great. If you go back in time, the 70s is probably our golden years. We had the biggest air conditioner factory in the world. We had Proton just starting off. Everyone was sort of full of hope and anticipation of us starting into the car industry. We had Islamic finance pioneering that. That all seems to have faded. Industries left when China came on board. They all packed up and went. But guess what? They're coming back.
And when are they coming back? Because you're not the first one, Stuart, that's come on our shows and said that the investment flows in Malaysia seems to have turned. Now, we've been out of favor for quite a while, but in the last couple of months, or maybe the last 12 months, that seems to have shifted. Tell us a little bit more.
Well, it took me a bit by surprise as well. I think it's basically the China -1 policy. Concentration in single countries, people looking for second sources of production. We actually qualify quite well. We have very well trained workforce, especially in the electronic sector. I mean, Penang really is very good at what they do. And certain pockets in Selangor do as well. We've had some very big companies here, actually. Texas Instruments has been here for years. We've had the Motorola plants, which is now renamed. And they're all doing extremely well on the electronic side. We have quite deep experience in that area. And that's really becoming the darling of the global markets right now. So a lot of people are coming in. And don't forget, data centers is the other one. People say, data centers, yeah. They're not easy to bring on board. They require a lot of work. And we need to find out where we can actually locate them. But 5G is going to drive that demand for us.
And I think one of the things that helps us also is the fact that, or has helped us, is last year, Singapore, because it's now, I think data centers consume 7% of their energy consumption.
And rising.
And rising, they've capped the number of data centers in Singapore. So that's the advantage then for Malaysia. Then, I mean, next best thing, as you say, cheap, abundant land, far lower cost of energy as well.
No, and we have 30% excess energy here. Although it's not green, that's the only problem. Renewables are going to be the next big thing, and we have to really learn how we can tap into that market.
And so the ESG agenda is really top of mind for investors right now. How is that impacting REIT investments in terms of?
Well, it hasn't. Well, I think a lot of the REIT investors are now, I mean, they're doing sustainability, but not quite ESG. ESG, actually, I wrote a big article on ESG recently, and about 2 months ago, and suddenly everyone's talking about ESG. Not to say I'm a market leader in that, but I think that, bringing that to the forefront means a lot. Climate change is playing a big role. Look what's happened in the last few days in KL. I mean, we've seen storms, and we've had huge floods in Klang I've not seen in 50 years. KL, I've never seen rain like that in my life, except for 72, when KL went underwater, and that was just once. This happens every day now. So, I mean, climate change is becoming very central to people's strategies. And ESG means that for REITs, all their buildings in their portfolios have to be rejigged to comply with the latest LEED Gold standards, energy compliance. Okay, it also covers other areas, like corporate governance and social responsibilities, just mean how they treat their workers, which contractors they use, the cleaners they use for their buildings. Are they being abused? I mean, they may go for subcontractors, but those subcontractors also should be able to comply with high practices that actually find favor with ESG practitioners. We've had so many bad incidents here.
And you know what? I think it's long overdue, particularly in a Malaysian corporate context.
Oh, yes.
Subcontracting the problem is not, and keeping it out of your eye should not be the way that we deal with things.
Yeah, now ESG is becoming something that boards have to be responsible for. They have to take that direct responsibility. So they're driving the agenda within the companies. REITs will actually perform quite well because most of the buildings are well maintained to begin with. But I think to tweak them to better ESG compliance should not be a problem. But the fact is that all their portfolios have to be reviewed and upgraded in order to comply.
Now, Stuart, REITs have been affected, particularly in the retail, hospitality, and office REIT sector during the pandemic. Markets are opening up, borders are opening up now. What's your view on the outlook for REITs in these areas in the next 12 and 24 months?
Well, the big winners in the REIT space has been industrial and healthcare. They've both done extremely well. Hospitality has been really badly hammered by poor poor arrivals from overseas. The retail malls, same way, because they're closed and had to give so many concessions to the tenants to keep them in. Their income has dropped. If you look at the share price movements, you find that counters like Axis REIT has hardly shifted over the pandemic. Atrium, a new entrant, not new, it's been there for a while. They've actually gained about nearly 40% during the pandemic because they bought some new assets. So they're showing some clear, good strategies in terms of building up their equity. But I'll say that the mall REITs have been having a hard time. The hotel REITs have been having a hard time. The office REITs have been having a very, very hard time. There's so much stock in KL, and we don't know what to do with it.
So, Stuart, what's the way forward? Because especially in the mall sector, in the office sector, we are tremendously overbuilt.
Of course. There are 6 new malls coming into KL this year. Combined areas about nearly, I think, 7 to 10 million square feet. Crazy numbers. Already on top of what we call a depressed market. But don't forget, the ones that actually listed, the Pavilions of this world, the KLCCs of this world, their popularity is not going to go away. They're iconic. They're great bits of real estate. I always say, whenever I buy anything for a REIT, the first thing I ask myself, is the real estate good? The mistake people make is sometimes they buy for yield. You don't do that. You always buy for really solid real estate that has long-term value. And a lot of the REITs actually have good value. The ones that haven't, you can see, are the ones that are really not doing very well in the market. But there'll be winners and losers. I can see more M&A activity arising in the future. Mm-hmm. Consolidation, that has to take place. You get bigger, stronger portfolios to take them forward. See what happened in Singapore with the Logos and ESR. I mean, they joined up to become the 3rd largest property group in the world. Seriously, massive.
And so, Stuart, with that in mind, what are some key trends in REITs that you're seeing globally right now? Obviously, data center REITs being one of them.
Well, I think there's a switch in asset classes. People are looking at different asset classes. Education's one, data centers is another. I mean, the 2 data centers listed in Singapore are doing very well for themselves. They have huge pipelines. I think Keppel DC REIT has got about 2 billion assets in the pipeline. So I mean, their growth is quite secured. They're not looking or scratching for new properties because they're very integrated as an organization. They build, they lease out, and then they inject it into the REIT. So it's a wonderful formula for capital recycling. They keep on getting their money back and they keep reinvesting it again. Don't forget, REITs is really the formula that probably gave Capital Land this biggest boost. They started recycling their capital through their huge vehicles, and they really keep on moving that money around and using it to very good purpose.
Do you think Malaysia will get some of that spin-off?
Well, I think it's time we did our own business here. As I looked at and many of the big property companies are waking up to the fact that we need to look at this seriously. We have to be able to sort of build a portfolio of income-generating properties that we can put into a REIT, add to it, and recycle our capital. So I think this is starting to show. You can see it from the fact that we recently did a fund for Sime Darby Properties, 800 million, to actually provide them with capital to develop out their industrial assets. Now, Sime Darby was always a housing developer. They're pivoting to industrial because they see the big advantage in building big boxes on long leases and turning that into a portfolio for injection into a future REIT. So I think it looks sensible that they would do something like that. I don't know if they are or not, but I think it's pure speculation on my part, but it makes sense that many of the property companies have never looked at this business before are now seriously looking at it. It was easy before in the housing days, whatever you built sold. Yeah. It's not the case anymore.
There's too much stock around.
I know.
Now, Stuart, it's been a fascinating conversation. I've learned a lot during our conversation. But before we leave, any final thoughts you'd like to leave us with before we end this interview?
I've been in the REIT business now, 15 years. I belong to the Asia Real Assets Association in Singapore, which covers a lot of the regional REITs. So I have contact with what goes on in there. I still think it's a solid investment option for the investor on the street because, it's the only business in the world where you get a check in the mail every 3 months. Okay, and you have capital appreciation on your investment. I always said, keeping your money in the bank and an FD is the dumbest thing you can ever do.
Especially in a high inflationary environment that we're just in the early days of.
As the inflation comes, property prices, as you know, the historical hedge against inflation, they will rise and your assets will be protected. At the same time, you still get paid.
Yes.
But in the stock market now, you can see that there's a big pivot to value investing. And that's an interesting strategy. People are moving away from the so-called growth tech stocks and moving back to what I call the Warren Buffett formula, the solid, boring, dividend-paying businesses. So you're going to see a big shift in investor sentiment back to the bread and butter, kind of investments. And REITs are basically stabler than bonds to a large extent because they're so well asset-backed and well managed too.
Stuart, thank you very much for taking your time to be on the show.
Thank you, Brian. You've been a great host, and I look forward to watching more of your interviews in the future.
Thank you very much.
Thank you very much.
I'm Brian Fernandez, and we've been speaking to Dr. Stuart Lebroy, Honorary Secretary of the Malaysian REIT Managers Association and Chairman of Alpha REIT Managers Sdn Bhd on BizTech's Property Show. This video and podcast will be on our website, www.biztech.asia, as well as our various social media platforms. Please like and subscribe to our various platforms. Thanks again for tuning in.